Welcome to this explainer. Okay, today we're cracking open the ultimate strategic survival guide to navigating the incredibly complex playing board of UK taxation. We're specifically focusing on the core pillars of ACCA TX here. Look, whether you're prepping for your exams, advising a client, or applying these rules in real life, you know that a single misstep can cost you dearly. But hey, don't worry, in this explainer, we're going to break down the exact rules, those strategic power-ups, and the countdown timers you absolutely must master to not just survive, but totally win.
So here's our agenda for today's session. Consider this your table of contents for survival. We'll start with the scope of value-added tax, then look at calculating the VAT bill and utilizing VAT special schemes. After that, we'll hit those crucial tax administration deadlines, and finally, surviving HMRC penalties.
All right, let's jump right into Section 1, the scope of value-added tax. Think of this as laying out the playing board. Before you can even play the game, you gotta know what pulls a business onto the VAT board in the first place, right? So let's dive into this massive number right here, £90,000. This is the legal threshold for compulsory VAT registration. If your business's taxable turnover exceeds $90,000 in any rolling 12-month period, boom, you are legally forced into the VAT system. And guys, this is a classic trap where ACCA students and business owners alike get caught out. Notice I said a rolling 12-month period. It is not just your financial year, you literally have to keep an eye on this every single month. Oh, and if you expect your turnover to dip back down, you can only deregister if it's expected to fall below $88,000. Now, as you'll see, not all supplies are treated equally by HMRC. We've actually got 4 distinct tiers of VAT rates here. The standard rate is 20%, and that applies to most goods and services. Then you've got the reduced rate of 5% for things like home energy or renovations. But pay close attention to the bottom 2 rows. 0 rated at 0% for items like food and books, and exempt for things like insurance and health. The absolutely crucial difference here is input VAT recovery. See, if you sell 0-rated items, your rate is 0, sure, but you're still technically making taxable supplies. That means you can recover the input VAT on your purchases. But if you sell exempt items, there's no VAT, but you generally cannot recover your input VAT. It's a huge distinction. Moving on to Section 2, calculating the VAT bill. This is the mechanics of the gameplay.
Okay, so this is the core mechanic of the whole thing. It's where we figure out exactly what you owe HMRC or what you can claim back. The basic calculation, pretty simple. Step 1, you take the VAT you charge your customers, that's your output VAT, and you subtract the VAT you paid on your business purchases, your input VAT. If it's a positive number, you pay HMRC. Easy enough, right? But wait, what if you make both taxable and exempt supplies? Well, you become what's called partially exempt. So the absolutely critical point here is Step 2, the strict partial exemption de minimis test. To fully recover your input VAT on those exempt supplies, your exempt input VAT has to be less than $7,500 per year and less than 50% of your total input VAT. And let me be clear, HMRC doesn't do close enough. You've got to meet both conditions. If you go over either one, your recovery is restricted. Stay under them and you recover the whole shebang. All right, let's look at Section 3, utilizing VAT special schemes. I like to call these the power-ups for small players. You know, standard VAT rules can be a seriously heavy administrative burden, but HMRC actually provides some strategic cheat codes or power-ups designed specifically to help smaller players survive and even thrive. Let's compare 2 of the best ones side by side. If cash flow is your biggest enemy, the cash accounting scheme is your shield. Normally, you'd pay VAT based on the invoice date, but with this scheme, you only pay VAT when your customer actually pays you. Huge lifesaver. And it's available if your turnover is up to £1.35 million. On the flip side, if administrative simplicity is what you're after, the flat rate scheme is your weapon of choice. Instead of calculating all that output minus input stuff, you just pay a fixed percentage of your gross turnover, which depends on your trade sector. You can join this one if your turnover is up to £150,000. And that brings us to our third major power-up, the annual accounting scheme. If your turnover is up to £1.35 million, you can slash your paperwork burden dramatically with this. I mean, instead of filing 4 quarterly returns, you submit just 1 single VAT return a year. Now, you still have to make monthly or quarterly payments towards your bill, but the total administrative headache of constant filing, completely gone. It's a real game changer. Okay, Section 4, crucial tax administration deadlines. It is time to beat the clock. Now, we're going to accelerate our pacing a bit here because we're entering the phase where you are quite literally playing against the clock, and missing these timers has severe consequences. So here's your income tax countdown timer. The tax year ends on the 5th of April. If you're old school and filing on paper, you've got until the 31st of October. But listen, circle January 31st in thick red ink. This is the absolute non-negotiable deadline for online filing. It's also the deadline for your balancing payment and your first payment on account if your previous year's liability was over $1,000. After that, your second payment on account is due strictly on the 31st of July.
So let's see how this builds for companies and VAT-registered businesses. These are the gold standard one-line summaries you literally must commit to memory. Ready? For VAT, your filing and payment are due 1 month plus 7 days after the quarter ends. Now, for corporation tax, HMRC throws a bit of a curveball. You actually have to pay your tax before your final filing deadline. Yeah, it's 9 months and 1 day to pay, but you get a full 12 months to file your CT 600 return. Whatever you do, don't let that reverse logic catch you out on your exam or in practice. And finally, Section 5, Surviving HMRC Penalties. These are the game over conditions. Which brings us to our final high-stakes phase, the actual consequences of failing to comply with everything we've just talked about. So what really happens when the clock runs out? Well, if you miss those deadlines, or if you miscalculate those thresholds, you are instantly in the danger zone. And let me tell you, HMRC does not play lightly when it comes to penalizing mistakes. These penalties escalate brutally. First up, late filing triggers an immediate, automatic 100-pound penalty, which is then followed by daily penalties the longer you wait. Second, if you pay late, you're getting hit with interest at the base rate plus 2.5%, plus flat 5% surcharges at the 30-day and 6-month marks. Third, and this is scary, if your return is inaccurate, penalties range from 0 all the way to a devastating 100% of the tax lost, depending on whether it was careless or deliberate. Yes, HMRC can essentially double your bill if they suspect deliberate concealment. And finally, HMRC holds terrifying powers, including demanding information notices and launching discovery assessments if they even just believe there's been a loss of tax. As we close out this explainer, I want to leave you with one final, vital thought. Memorize the numbers, apply the rules. Mastering these ACCA TX thresholds and deadlines, it isn't just about avoiding a 100-pound fine. It's the ultimate strategy for financial survival. It gives you the power to optimize your cash flow, utilize those special schemes we talked about, and steer perfectly clear of HMRC's game over conditions. So whether you're looking at your own numbers or sitting down for your next exam paper, ask yourself, are you playing the tax system or is the tax system playing you?